All right, welcome to the video lecture on just a smidge of chapter 16, most of 17, and just a small part of 19. So we start with chapter 16, and really the only topic we're going to cover in this chapter is installment sales. And so Obama sold used equipment to Donald for $100,000, and he gets $10,000 down and a 7% note for the balance payable in 3 installments of $30,000. So $30,000 a year. That's payable in the next 3 years. And this shouldn't be Donald's basis. This should be, this should be Obama's basis was 20,000. So when he sells it, amount realized 100,000. The adjusted basis is 20,000, and so his realized gain is 80,000. And if it weren't for the installment sale method, his recognized gain would be 80,000 too. But notice that he's only getting 10,000 down, and the rest of it is payable over the next 3 years. So what this really means is he doesn't end up with really very much cash in his pocket, and he's probably not headed for Vegas. So that's what the installment method is all about. It allows us to recognize the gain ratably as payments are received. So this applies in the sale of property where the seller receives the sales proceeds in more than one tax period. You recognize a portion of the gain as each installment payment is received. And the percentage you recognize is known as the gross profit percentage, which is generally the gain realized over the amount realized. That's in its most basic form. The installment sale method can't be used for inventory, can't be used for marketable securities, and any depreciation recapture. So any 1245 or 291 for that matter cannot be accounted for under the installment sale rules. And the installment sale method does not apply to losses, but that makes sense because you'd want to recognize those immediately anyway. So when we think about the example we just did with Obama and Donald, the gross profit percentage is going to be 80,000, right? That's the gain. Let's go back and look at the gain realized, right? Over the amount realized. And the amount realized is 100,000. So the gross profit percentage in this case, 80%. So as Obama receives a dollar, 80 cents of that dollar will be recognized as gain. So now when we go back and look at what is the amount of gain recognized, well, under the installment sale, it depends on how much cash he's going to get. So in year 0, at the time of sale, he was going to get 10,000 down. So he'd recognize taxable gain of 8,000. And in the following year, when he receives that first $30,000 payment, 80% of that is 24,000. And then each subsequent payment of 30,000 is subject to the same recognition of gain. And note that when you total the taxable gain recognized over time, 80,000, that needs to agree to the realized gain because the installment sale method doesn't change the amount of the gain. It only changes the timing of when it is recognized. 2 important notes, of course, the interest is recognized separately, and that's going to be his interest income. So recall that he was getting a 7% note. So what that means is if you can have imputed interest on installment sales as well. We're not going to get mixed up in that, but note that it is fairly common. That's one of the areas where you see a lot of imputed interest is installment notes that don't have a stated rate of interest that's equal to the applicable federal rate. And then, of course, as I just mentioned, the total amount of the gain doesn't change, only when it is recognized. So again, as I mentioned, recapture must be recognized in the year of sale. That means you can't defer it. So if we relook at this deal, we assume an original cost of 70,000. Recall the basis was 20. It was sold for 100. The implication is that he's had $50,000 worth of depreciation. That's the original cost down to the adjusted basis that currently exists. What that means is that $50,000 must be recognized in the year of sale, right? Because that would be 1245 recapture. So you have to recognize the ordinary gain on that in the year of sale. The remaining 30,000 of gain, right? That's the 80,000 less the 50 you're going to recognize. That is now subject to the installment method. And so the gross profit percentage is adjusted to reflect that. And here's what the gain recognized would look like over, that 3+ year period where we'd apply the gross profit percent instead. And notice that, we're going to recognize still the same 80. It's just 50 of it is going to occur immediately at the time of the sale. Okay, so now let's plop ourselves into the next chapter and talk about corporations. And really what we typically do from an instructional perspective is talk about how corporations differ from what you've already learned. And so, a lot of times we focus on that. But more generally, we know that corporations are taxed as a separate entity. They have their own unique tax rate. It's really just 21%. The character is fixed, meaning any distributions that come from a corporation are just treated as a dividend. Now, we'll break that down a little bit later and find that that's not 100% true. It's just mostly true. And losses aren't passed through, right? The NOL stops at the corporate level, unlike a flow-through that can pass those losses through if it can get past basis at risk. And if it's a passive activity, the passive loss limitations. Dividends are not deductible for a corporation, so that implies that payments to an owner for salary, rent, and interest might be more favorable because they represent income on the part of the shareholder, but they also represent a deductible expense on the part of the corporation. And there are some non-tax issues, of course, associated with the choice of a corporation, like limited liability. Generally, you think of corporate stock as being liquid and fairly easy to transfer, as opposed to like interest in a partnership. It has continuity of life, so the corporation continues even when an owner dies, and the luxury of centralized management if the business is starting to get fairly large. And of course, a corporation can make an S election to be treated as an S corp, and that's actually going to be next week. We'll dig in on that pretty deep. So, Inc. Corporation earns $100,000 taxable income and distributes all of its after-tax income to its shareholders. So let's think about what that looks like. Inc. will pay tax at $21,000, right? Because it's going to earn $100,000 of taxable income. Times 21% is the $21,000. That only leaves $79,000 available to pay as a dividend. Now, that dividend isn't deductible, as we've learned, but it is, of course, taxable to the shareholder. And just for ease sake, let's say shareholders taxed in the 15% category. That means the shareholder level tax is $11,850. And so you can see, even though corporate tax is 21%, the total tax on corporate earnings is 32.85%. So let's talk about those unique differences in the calculation of taxable income. So the first is how the treatment of net capital gains. Really, it's the treatment of net capital losses. We've really already covered Section 291, but we'll do that again. Passive activities, there's a more lenient standard for corporations. Charitable contributions, they have a different limitation than individuals. Than individuals do. There are some limitations on executive compensation for public companies, and the NOL rules are really the same. We've covered those as it relates to individuals, so that should be fairly redundant. And they do have this thing called a dividends received deduction, and so we'll go through each of those in a little bit so that you can see how those differ. So you should be used to the idea of capital gains and losses for a corporation, which is, of course, corporations may not deduct net capital losses. So that $3,000 that an individual can deduct, that's not available to a corporation. Instead, a corporation can carry back its net capital losses 3 years, and then if nothing there, can now carry them forward for 5 years. First in, first out must apply. You have to go all the way back all 3 years if possible, and then work forward. And the carry back or carry forward for a corporation is just flat out treated as short term. And the cap loss carry back or carry forward can be limited. And we'll talk about that more after we get through NOLs, because there's an interaction between net capital losses and NOLs that sometimes puts a halt to taking a net capital loss. There's no rate differential for corporations, right? So long-term capital gains, short-term capital gains, ordinary income, it's all taxed at 21%. So just quickly, we'll redo Lola, real property. This was when Lola was an individual, and recall that we treated that that non-recaptured depreciation is unrecaptured 1250, taxable at 25%. And if Lola is a corporation, however, you treat that 20% of that unrecaptured amount as ordinary under Code Section 291. And again, that should be reasonably redundant to you. Passive activities in general, corporate activities are deemed to be active. So that means that, corporation generally isn't subject to the passive loss limitations. However, if it's a closely held C Corp, then they don't necessarily get to presume active treatment for a passive activity. Closely held means greater than 50% of the stock is owned by 5 or fewer individuals, and that's at any time during the tax year. And in this case, even if that's true, you can offset passive losses against net active income, so your active trade or business income, but not portfolio income. And really, this prevents the establishment of a closely held C Corp that you could then push your passive losses through that would, in any other circumstance, be limited. So charitable contributions, the timing, almost all accrual method corporate. So if you're cash basis, you don't get to deduct it until you pay it. For an accrual-based corporation, you can accrue a charitable contribution as long as it was approved by the board of directors of the corporation before year end, and you pay it within 3.5 months after year end. So, some relaxation on your ability to accrue a charitable contribution as a corporation. So the amount of the deduction for a charitable contribution, if it's capital gain property, that's generally its fair market value. That's really what we're used to for individuals as well. If, however, the contribution is tangible personal property and it's put to an unrelated use by the charity, or it's a contribution to a certain private foundation, and we don't get too mixed up in what those private foundations are. But in either of those instances, you would use basis as the amount of the deduction, not the market value. If you donate ordinary income property, so think of that as a corporation donating its inventory, typically, you'll take the adjusted basis in the property, again, not its market value. However, there are exceptions to that rule. So if a corporation contributes inventory to a charity whose purpose is care of the ill, needy, or infants, or they contribute research property to a school or research lab for use in research, then the amount of the deduction is the basis plus 50% of any appreciation in the property, or double the basis, whichever is lower. So you calculate both of those items, and the amount of the charitable contribution deduction is the lower of those two. All right, let's do some examples. So a corporation donates land worth $1 million, basis of $100,000, and the charity sells the land. Well, that's capital gain property because the charity is not using it for its intended purpose, right? That isn't tangible personal property, right? That's real property. So it doesn't matter that it's an unrelated use under exception 1. And so as a result, they're going to take $1 million deduction for that. If, on the other hand, they donate computers, those computers have a fair market value of $10,000 and a basis of $800,000. If the charity uses the computers for its purpose, then in fact it is using it for a support for a related purpose, and as a result they retain that fair market value as the amount of the donation. If, on the other hand, as in the next example, they donate the computers but the charity just sells them, then that does meet that exception, right? If we go back, that's a contribution of tangible personal property put to an unrelated use by the charity, meaning it just sells them. And so as a result, they're going to take basis in that deduction, not the fair market value. A corporation donates hardware, nuts, bolts, screws, etc., inventory to charity. So this is the instance, think of it like it's Home Depot. And they're donating part of their inventory to charity. The inventory's market value is $10,000. The basis is $8,000. The charity uses the inventory for its purpose. So in this case, we're going to try to meet this one of these other exceptions. We do have ordinary income property. It is inventory. However, it's not for the ill, the needy, or infants. And so as a result, that's going to go out at basis $8,000. If, on the other hand, the food inventory goes to a food bank, that is going to meet that definition, right? The charity uses food to feed the poor. So we have inventory contributed to a charity. The purpose is care of the needy. And so as a result, we get the lesser of the basis and 50% of the appreciation, or the basis times 2. If we look at the items here, so we've got basis plus half of the appreciation would be $9,000. Basis times 2 would be 16. So they're going to take $9,000 as their deduction. And again, that's the basis plus the increase times 50%. They donate food to a charity such as a food bank. Inventory is $20,000. Basis is $8,000. Charity uses food to feed the poor. So really, we've got the same exception here, but we just need to calculate which of the two amounts is lesser. So in this case, if I take the increase in the market value over the basis, that's 12,000, times 50% is 6,000. So you add 6,000 to 8,000, that's 14,000. If I just double the basis, that's 16,000. And again, since I'm taking the lesser of those two, that's going to be the 14,000. So for corporations, charitable contributions are limited to 10% of modified taxable income. That number was bumped to 25% in 2020 and 2021. The modified taxable income is you take the taxable income, and of course, you're not allowed to deduct any charitable contributions first. You would add back any dividends received deduction, which we'll get to as part of this video. You would add back any NOL carrybacks or capital loss carrybacks. And anything in excess of that, you carry forward for up to 5 years. So any charitable contributions that's limited by the income can be carried forward for up to 5 years. So when we think about this charitable contribution, there's really two styles of questions that you get in the academic setting, and I want to cover both of those. Of course, in real life, there's no academic setting. So one is you get taxable income, and that includes or excludes charitable deductions, DRD, carryback, etc. I refer to that as the top-down approach. And then the bottom-up approach is here's sales, operating expenses, charitable deduction, DRD, etc. And it's your kind of job to calculate taxable income. So in the first one, you have taxable income, and you would reconcile that to modified taxable income. In the second one, you kind of just compute modified taxable income. Okay, so in 2022, and I picked 22 because I want to get back to the 10% limitation. Slughorn Corp donates $700,000 cash to the Red Cross. It's taxable income before the charitable contribution deduction, before NOL carryover, and before the DRD was $6,287,000. So what is Slughorn's charitable contribution deduction for the year, and what's its carryover? And so this is a classic must reconcile income, right? So we start with taxable income, and we need to reconcile that to what modified taxable income is supposed to be. So start with the taxable income, 6287000. The carry over is deductible. Remember, it was carry back that is a reconciling item. So we get the carryover. The DRD we ignore. And of course, the charitable contribution we ignore. So that gives us modified taxable income of $6,263,000 times 10%, $626,300, and so we would have a limitation. Our $700,000 of cash donations would be limited to $626,300. In the second version, what you'll see is we're going to give you the delineated expense and income items. So gross income is $10 million, business expenses, including a charitable deduction of $700,000 or $4,413,000. I have an NOL carryover and a DRD of $21,000. We have to do the same calculation, but we do it slightly differently, right? We don't start with taxable income and reconcile. Instead, we really just need to calculate modified taxable income. So the gross income is in there. The deductions are in there. We get the taxable income before any adjustments. Then we would adjust it for the charitable contribution. We would adjust it for the NOL carryover. We get to the exact same place. So you can see these questions. It doesn't matter which direction you come at it from, but you do have to pick the right direction depending on the info that you are given. So the executive compensation, this rule is under 162M. There's a special rule on the deduction amount that's allowed for salaries of a covered employee. A covered employee is one at a publicly held corporation. And a covered employee is the CEO, the CFO, and the other three highest paid executives or officers. So it doesn't matter what their title is. It's the CEO, the CFO, and then the other three highest paid. Starting in 2026, you add an additional five other highest paid. So you're technically up to, let's do the math on that, CEO, CFO plus three. That's five, and then you're going to add two more highest paid to get to eight. Sorry, three more highest paid to get to eight. Note that once you're a covered employee, you're always a covered employee, starting after 2016 when they put that rule into place. So even if you're dead and you manage to get some payouts to your estate or whatever, you could still be a covered employee. If you had performance-based compensation, that could have been grandfathered in if you made no material changes and it was in existence on November 2nd of 2017. And then lastly, this limitation doesn't apply to qualified fringe benefits. For example, healthcare or contributions to a retirement plan. So Big Public Corp pays the CEO Mary $2 million. $500,000 in equity-based compensation, $12,000 in employee healthcare premiums, and a $50,000 retirement contribution, and that's well below the cap, no matter what the year is. And so, what is the after-tax cost of the compensation? So, of course, they pay her $2 million plus $500,000 plus the 12 plus the 50, so that's the $2,062,000. The deductible amount of that, though, is limited to the $1 million plus the fringe benefits, so that's $1,062,000. 21% tax savings is $223,020. That means the after-tax cash flow is just higher than $1.8 million. Okay, so net operating loss, we already discussed it kind of the individual level, so we don't need to go through that. We've already talked about these rules. So let's just remind ourselves where we stand, just for posterity's sake. So here we are down here on the bottom rung in this light green. So NOLs that begin on or after the 1st of 21, generally there is no carryback. You can carry forward them indefinitely, but you can only offset up to 80% of the taxable income in that future year. So I had mentioned that there's an interaction between NOLs and net capital losses. Let's dig into that now. So you can't, of course, there's no deduction for a net capital loss for a corporation, right? And we discussed earlier in the video that you can carry back 3 years and forward 5 years. However, this interaction limits the carryback of a net capital loss if it creates or increases a net operating loss. So let's discuss that for a second. XYZ Inc. has a net capital loss of $4,000 for the 2020 tax year. XYZ reported the following taxable income in 18 and 19. So in 18 had an NOL of $17,000, but inside that NOL was $2,000 of net capital gains. In 2019, had $8,000 of income, and that included $13,000 of net capital gains. And so what options does XYZ have with respect to that current year net capital loss? So, of course, it would need to carry it back first 3 years and then forward 5. So its earliest year back would be 2018. And even though there are capital gains in 2018, you can see that what happens is if you offset those capital gains, then the NOL is increased, and that is not permitted, right? So you cannot carry back the NCL if it creates an NOL, which means we'd have to go into 2019. Notice that in 2019, we can go ahead and push back that capital gain, that capital loss, I should say, against it, because taxable income is $8,000 beforehand, and of course it only goes to $4,000 after the fact, right? So we do not create an NOL or extend an NOL by applying our net capital loss since 2019, which means we can do so. Okay, so the dividends received deduction is to deal with situations where the parent corporate owns 100% of a child corporation. And if the child corp generates 100,000 in taxable income, that corporation pays 21% tax because they all do, which means that 210,000 of taxes paid. That would leave 790,000 to distribute up to the parent. But recall that the parent is going to get that $790,000 dividend and pay 21% tax on it. Then on top of that, the individual that then receives the distribution from that parent corporation is going to pay, 15 or maybe 20% tax on it. So what happens is on income of about $1 million, you end up with a 47% tax rate. And so this is the purpose behind the dividends received deduction. It's designed to mitigate the effects of double taxation when you have a chain of corporations, parent, child, grandchild, et cetera, et cetera. So there are currently 3 different DRD percentages. And these depend solely on what the ownership percentage is of the corporation. So 0 to below 20% is a 50% DRD. 20% to just below 80% is a 65% DRD. And if you own more than 80% or more of the child corporation, then you get 100% DRD. There's a limit on the DRD. And that's either the dividend times the DRD, which we'll discover is really just the DRD itself, or DRD modified taxable income times the DRD percent. So what is DRD modified taxable income? Well, that's your taxable income before any DRD, before any NOL carryback, and before any capital loss carryback. However, unlike the net capital loss, which recall if it created an NOL or extended an NOL, it was limited. It's the opposite for DRDs. So if the DRD extends or creates an NOL, then this limit does not apply. It does not apply. So really the only way to see this is through an example. So let's start with this first example, Haggard Corp. And in this case, their interest in all of these examples, they have a less than 20% interest in the subsidiary. And that's because we're just going to apply a 50% DRD across the board. So Haggard has gross income of 400,000, expenses of 340. It receives a dividend of 200,000, and so its taxable income before the DRD is 260,000. So the first step is to compute the full DRD, and again, since it's less than 20%, that's the dividends received, 200,000 times 50%, or 100,000. The taxable income limit is taxable income before the DRD, that's 260,000. Times 50%. So that's 130,000. So the lesser of those two is the full DRD. And so as a result, they do not cause an NOL. And so they can take the full DRD, the full 100,000. McGonigal Corp has gross income from operations of only 320,000. Everything else is the same. But of course, that drives a lower taxable income. Now taxable income is only 180,000. So the full DRD remains 200,000. That's the dividend received times 50%. That's 100,000. But in this case, the taxable income limit is 180,000 times 50%. Again, the same DRD percentage. That's only 90,000. And as a result, the DRD is limited to that 90,000. In our last example, gross income is way down. It's only 210,000, and so our taxable income before the DRD is 70,000. Again, the full DRD is 100,000. The taxable income limit is 70,000 times 50%. However, in this case, if I took the full DRD, it would in fact create a net operating loss, right? It would be 70,000 minus 100,000. Because I create a net operating loss, I am entitled to take the full DRD of 100,000. So there are some rules about being eligible for the DRD that are related to the underlying ownership of the stock. And the bottom line is you need to have held the stock for more than 45 days during the test period. And the test period relates to when the dividend was declared. And so basically you look at what's called the ex-dividend date. You go back 45 days and make sure that it was held for at least that long. And if so, you're generally entitled to the DRD. So as long as you hold it for long enough, you get the DRD. And if you've only held the stock for a short amount of time, they don't let you take it. So when we calculate corporate taxable income, we usually start with financial income. Most corporations keep books and records. In fact, kind of they're required to. And so as a result, we usually start with financial income and then we reconcile that to taxable income. We use what's known as book tax adjustments. Now, we don't dig in real deep on this part in this course. This is better served in our 657 class and in 651 as well. But, we take book tax differences, right? So what differs between book and tax, and we make those adjustments. So we report corporate taxable income on a Form 1120. Even though this is an old 1120, the 1120 hasn't changed much over the years. And so you can see you kind of start with an income section and report the blowout of some of that income information. Then you get to the expenses section and report some of the detail of the deductions. Pay attention to line 27. That's total deductions. Right after that, line 28 is a taxable income, but that's a taxable income before NOL and special deductions. Note that special deductions, Schedule C, that's your DRD, right? So, and that's convenience for certain states. What you'll find is at the state level, some states start with line 27 and others start with line 29, and you just got to know which state you're dealing with. Oh, and here's a quick snapshot of Schedule C to show that that's what those special items are. So the corporate tax return requires what's known as an M1 or currently also an M3, which is a much larger version. We'll do the M3 if you have me for 651, but we don't do it in this class. So Schedule M1 is a reconciliation. Look at line 1. What is it? Net income per books. What do we reconcile to? Income from page 1, line 28, right? What was page 1, line 28? That was taxable income before net operating loss deduction and special deductions. So you're required to complete that reconciliation. And you can see the note that you may be required to do an M3. And that has to do with the size of the underlying corporation. So if we look at, for example, Ravenclaw Corp., if it has net income per books of 100,000, first thing we would add back is federal income taxes because we do not get a deduction for our own income taxes. That leaves us with pre-tax income, and then we would reconcile that. You can see add back depreciation per books. You would deduct depreciation per tax. You might add back 50% of the meals that are non-deductible. You would deduct municipal interest to the extent that the corporation earned any tax-exempt income. You would add back any legal reserves that are non-deductible under the all events test. Same with the allowance for bad debts. And that's how you would reconcile to get to federal taxable income. Here's what that would look like on a Schedule M1, just so you can see one printed off. It is not unlike me to ask you guys to fill out an M1 as part of your final exam. And it feels and looks a lot just like this one. Corporate compliance, again, a Form 1120. These are now due on April 15th. There was a time, 5-6 years ago that they were due on March 15th. That's no longer the case. The corporate deadline is generally the same as the individual deadline. So April 15th. But remember, corporations can be fiscal year ends. So 4/15 for a calendar year end. Almost all individuals are calendar year end, but a corporation has a lot of flexibility. Okay, so now we're into this last part of the corporate and into the next chapter, which I think is 17. And so let's talk about corporate distributions, right? So we've been mentioning that when a corporation makes a distribution, we generally treat that as a dividend. And I said we were going to relax that requirement in a little bit, and here we are. So let's remember that basis of the investment, you get back tax-free. I've tried to drill this into you guys over time, and so hopefully part of that is sticking with you. So let's say Billy White invests in Cheesecake Factory stock for $1,000, and then he sells the stock a few days later for $1,100. We know that he gets to recover his basis, and by doing so, that's the amount of those proceeds, the amount realized he gets back tax-free, and so his realized gain and probably recognized gain is only $100. So what if instead of buying stock, Billy White actually contributes $1,000 to form a corporation. And the corporation puts $800 in money to work and it buys assets. It leaves the other $200 in cash. And then it makes $150. And so if we think about what its balance sheet would look like at the end of the year, it's got cash of $350, right? So it's got $200 left over from what Billy contributed, plus the $150 that it made. It has that asset, right? We don't know what the asset is, but it's worth $800. So total assets are $1,150. Owner's equity is $1,000. That's what he put in. And of course, it has retained earnings because it made, $150 worth of cash. And so its balance sheet balances out. So what would happen if this corporation made a distribution to Billy? Well, the rules say what we'll find is that generally speaking, distributions first come out of earnings, or what's known as earnings and profits. And so as a result, a $100 distribution would come out of the $150 that corporation earned. And that's treated as a dividend, right? Because that distribution is made from corporate earnings and profits. If instead it distributes $200 to Billy, well, then what would happen is it would have cashed out all of its earnings and profits. And so to the extent it's giving $50 back to him, that must be part of the $1,000 he originally contributed. So as a result, he's getting back some of his capital. And so that would be a $150 dividend, but also a $50 return of his basis or return of capital. So let's modify this slightly and say that the corporation during the year also borrows $200 from a bank. Okay, so now when we look at his balance sheet, cash is up to $550, right? Because it's got the $200 left over from Billy's contribution, $150 of earnings, and $200 from the bank. It still has that $800 asset. Total assets are up to $1,350. And on the liability side, now there's a $200 liability. So, note payable to the bank, owner's equity still $100. It's got the retained earnings of $150. So in this case, what would happen if the corporation made a $1,200 distribution to Billy? Well, first is $150 would come from earnings, right? Because that's the earnings of the corporation. $1,000 of that would be a return of Billy's investment. The remaining $50 would need to come from somewhere else, right? And basically that must be part of the bank's money. And as a result, Billy's got back all the earnings of the corporation. He's got back all the money he put in. What's that additional $50? Well, that's got to be income. And so that's the way the rules treat it. So that is in fact the exact pecking order of a corporate distribution, right? First, it's a dividend to the extent of the corporation's earnings and profits. Then it's a return of capital, or a return of your basis to the extent of your basis in the investment. And then anything in excess of that is actually treated as a capital gain. Okay. So the characterization of this distribution has important tax consequences, right? Because obviously it's non-deductible, no doubt there. But to the extent it's a dividend, it's taxed twice. To the extent it's return of capital, it's not taxed at all. And to the extent it's treated as capital gain, it's taxed as a capital gain. Okay. So that means we really need to understand what is the tax law definition of a dividend. And as I've said, it's a distribution of property made by a corporation to its shareholders out of its earnings and profits. So there are two separate earnings and profits accounts that a corporation must maintain. The first is called current earnings and profits. And think of that as the current income for the year. It's what you might see on the income statement, except tax calculated. And then the second one is accumulated earnings and profits. And think of that as the same concept as retained earnings. So that's the earnings that you've retained from prior years. So current E&P not distributed to shareholders is just added to accumulated E&P on the first day of the following year. So to the extent you generate current E&P, right, you have current earnings and profits and you make no distributions, and what happens is you just take those and add them to accumulated earnings and profits at the start of the next taxable year. So you're required to compute earnings and profits using a separate accounting system because it's not the same calculation as book income. It's not the same calculation as taxable income. It's the calculation of earnings and profits. And generally what happens is you start with your taxable income or loss, and then you make adjustments that are required by the Internal Revenue Code. So these adjustments fall into four broad categories. So the inclusion of income that is excluded from taxable income, the disallowance of certain expenses that are deducted in computing taxable income but do not require an economic outflow, the deduction of certain expenses that are excluded from the computation of taxable income but do require an economic outflow, and then the deferral of deductions or the acceleration of income due to separate accounting methods that are required for E&P purposes. And we're not going to spend a lot of time on this section. Again, I tried to defer this into my corporate tax class. Just a basic understanding of E&P is far more important at this point. So when we think about that first category, inclusion of income that might be excluded from taxable income, tax-exempt interest, right? So you got to think of it as if a corporation generates tax-exempt interest, that is still income. And so to the extent it distributes that tax-exempt interest out to you, that is going to be treated as a dividend because it's coming out of the earnings and profits of the corporation. The disallowance of certain expenses that are deducted in computing taxable income but do not require an economic outflow. For example, the DRD we just covered, NOL carryovers from prior periods. Those are deductions, but there's no economic outflow associated with those, at least not in the current year. So expenses that are excluded from taxable income but do require an economic outflow are those federal income taxes paid or accrued. So even though clearly we don't get to deduct those, we definitely are less rich as a result of paying them. Same with expenses incurred earning tax-exempt income. Recall that those are non-deductible, but we can include them as a deduction for E&P. And charitable contributions that exceed our limitation, those are deductible for E&P as well. And then acceleration or deferral, a classic example of something like that might be an installment sale. So there are four possible states of E&P. You can have positive current, positive accumulated, positive current, negative accumulated, negative current, positive accumulated, and negative current, negative accumulated, right? So there's positive, positive, negative, negative, positive, negative, negative, positive. And what happens is the treatment of a corporate distribution differs under each of these different scenarios. That's why we need to understand what the states are. Okay, so example one, current E&P is 1.2 million, accumulated E&P is 500,000. This looks like a classic positive, positive, right? These are both positive. The corporation distributes $1 million on July 1st. Well, when you have positive, positive, the distribution is deemed to come from current E&P first and then accumulated E&P. So the distribution of $1 million would come all from current E&P, wipe that down to 200,000. We wouldn't even touch accumulated E&P, and as a result, all of that would be a dividend. In our second example, we've got current E&P of $1 million and accumulated E&P of negative 500,000. And again, the corporation distributes $1 million on July 1st. Again, the rule says the distribution is deemed to come first from current E&P. As a result, all of it would be treated as a dividend. And even though total E&P might only be 500,000 at year end, doesn't matter. And sometimes you'll hear this called a nimble dividend. Example 3, current E&P is negative, positive accumulated E&P, and the corporation distributes $1 million on July 1st. This is probably the trickiest of the four scenarios because in this particular instance, you have to calculate total E&P at the date of the distribution. So accumulated E&P at the date of the distribution is whatever it was when we finished last year end. So that's the 500,000. Current E&P is what E&P would be on the date of the distribution if it were prorated. And technically, you're supposed to use the number of days, but for this example, I just slice it right down the middle. It's July 1st. So think of it as half a year, right? So of the 600,000 in total current year E&P, 300,000 of that would be prorated through June 30th or July 1st. And as a result, total E&P on the date of the distribution is the accumulated of 500,000 less the 300,000 negative of current is 200,000. And as a result of that $1 million distribution, 200,000 would be a dividend. Then, of course, we'd flip down and go into basis, and then any left over would go to long-term capital gain. Example 4 is the easiest. This is negative negative. Since there's no positive E&P, there is no dividend, and you just go right to return of capital. That brings us to the end of this particular video. Thanks for watching.